Greetings, everybody. Welcome to Liberty Call. Today is Wednesday, August 16th, 2023. Got some exciting news for you today. We're going to go through the Fed minutes, exciting stuff. We're going to go through the markets, what happened, market recap, and housing starts seem to be on the ascension, which, is that good news, bad news? Who knows? So anyways, if it's your first time watching Liberty Call, I'm glad you're here. Thank you very much. If you could, give me some thumbs up, likes, shares, subscribes, follows, hit the notification bell. I would greatly appreciate it. And let's go ahead and jump into the numbers. Eyes itching. Sorry. All right. Dow Jones was down 0.52%, 180 points, closed at 34,765. S&P 500 down 0.74%, closed at 4404. NASDAQ down 1.15%, closed at 13,474. The VIX up 1.88%, closed at 1677. Canada was flat at 0. Its change was 0.72 points. Brazil down 0.4 and Mexico up 0.52%. Over in Europe, Germany was up 0.14%. The UK down 0.44. France down 0.1%. Netherlands down 0.32. What is this? Spain up 0.03. Hang on a second. All right, where were we? Italy down 0.93%, Switzerland up 0.06%, and Portugal up 0.21%. Russian exchanges were split again today. MOEX down 2.11%, the RTSI up 0.44%, and the overnights in Asia, nothing but red for the most part. The Nikkei in Japan was down 1.39%, Australia down 1.5%, New Zealand down 1% flat or even. The Shanghai in China was down 0.82%. The Shenzhen component down 0.94%. The China A50 down 0.29%. DJ Shanghai down 0.72%. And the Hang Seng down 1.23%. Taiwan weighted came in up 0.37%. The lone bright spot in the Asian markets for today. So anyways, all righty. Let's close that and get the market recap up here for us. S&P 500 slips as Treasury yields take flight on fears of further Fed tightening. Uh-oh, that doesn't sound good. All right, on Wednesday, the S&P 500 experienced a 0.6% decline due to a surge in Treasury yields driven by concerns raised by the Federal Reserve's July meeting minutes. These minutes suggested that, quote, significant, end quote, upside risks to inflation could keep the possibility of further monetary policy tightening on the table later this year. This hawkish sentiment contributed to pushing Treasury yields to new highs not seen since October. All righty, let's see here. The decline in the market was led by the technology sector, with chip stocks experiencing a downturn. Tech giants like Intel Corporation, Coherent Inc., and AMD faced pressures that contributed to the broader market downturn. Intel's stock fell over 1% after the company abandoned plans to acquire Tower Semiconductor due to a lack of regulatory approval within the designated timeframe. As a result, Intel will pay $353 million breakup fee for discontinuing the deal. Meanwhile, Coherent Inc. experienced a more significant slump of over 30% following an unexpected Q4 loss. I'm sorry, that would probably be a Q2 loss and weaker than expected guidance. However, amidst this market movement, some companies stood out with positive earnings. Target Corporation reported second quarter revenues slightly below Wall Street expectations, leading to a cut in annual guidance. Despite this, the stock rose more than 1% as investors responded positively to leaner inventory levels and improved margins. Similarly, TJX Companies Inc. climbed 4% after increasing its annual guidance and surpassing Q2 estimates due to lower costs, enhancing margins. In the cryptocurrency realm, Coinbase Inc. Remained relatively stable after announcing its regulatory approval from the National Futures Association to offer Bitcoin and Ether futures to eligible U.S. consumers. This approval is expected to have a positive impact on the growth of the cryptocurrency exchange, as crypto derivatives constitute around 7% of global crypto trading. Overall, the market movement was largely influenced by the Federal Reserve's meeting minutes, which indicated that inflation concerns could lead to further tightening of monetary policy. The technology sector faced pressures from chip stocks and specific company issues, while some companies managed to shine with positive earnings reports. The cryptocurrency market also made a notable move as Coinbase gained approval to offer crypto futures. All right. Exciting stuff, isn't it? All right. Next up, U.S. housing starts surge in boost to the economy. Let's see what's going on in the housing market. All right. In July, U.S. single-family home building experienced a significant surge accompanied by an increase in permits for future construction. This development occurred amidst a severe shortage of previously owned homes. However, the recent climb of mortgage rates toward near two-decade highs has raised concerns about a potential slowdown in the housing market's progress. This notable rebound in the initiation of single-family units, as reported by the Commerce Department, stands as another testament to the economy's resilience against predictions of a recession. I still don't think we're getting out of that. This growth followed the news that retail sales had also risen significantly in July, leading economists to revise their growth projections for the third quarter. With inflation retreating, economists do not foresee these positive data trends translating into another interest rate hike in the upcoming month. I personally do. However, analysts believe that the Federal Reserve officials might be cautious about interpreting these strong economic indicators as they gauge whether to proceed with further interest rate increases this year, given the progress made in curbing inflation. In terms of housing, single-family housing starts constituting of a large portion of home building surged 6.7%, reaching a seasonally adjusted annual rate of 983,000 units last month. This increase was primarily driven by the West and the Midwest regions. Despite the positive trend, the recent rise in mortgage rates, which have reached nearly 7%, could potentially impact home buyer confidence and lead to a slower market improvement. While housing starts demonstrated growth, the broader housing supply still remains tight, although permits for single-family home construction increased by 0.6% in July, reaching a rate of 930,000 units. The number of approved houses yet to be started fell by 0.4% to 277,000 units. The tight supply is reflected in the fact that the inventory of single-family housing under construction declined 0.7% to a rate of 678,000 units. Overall, the housing market appears to be displaying resilience, but the recent uptick in mortgage rates could potentially temper the pace of improvement. Economic experts suggest that the Federal Reserve officials might consider these developments along with inflation data when making future monetary policy decisions. Sure. Okay. Well, I mean, it's good news that, housing is still relatively strong, even with the higher rates. At some point, there's going to be an inflection point and it's going to tip over. But for now, things seem pretty good. All right. Last up, we got the minutes of the Federal Open Market Committee from last month. Their meeting was on July 25th and 6th. Let's go ahead, and this is going to take a little bit. We're going to go through each section. The first one is the developments in the financial markets and open market operations. All right. During the reviewed period, financial markets displayed resilience and perceived decreased inflation pressures. While economic data pointed to a robust economy, the market's projection of the peak federal funds rate slightly increased, then retreated following softer than expected June consumer price index release. Although market implied policy path shifted towards restraint, overall financial conditions eased, attributing to higher equity prices and narrower credit spreads. This period also saw growing confidence in the banking sector, leading to appreciation in bank equity prices. Measures of inflation compensation remained steady, aligned with the committee's 2% goal. Surveys indicated that while a recession probability by 2024 remained among market participants, the anticipated timing of a recession was postponed and the likelihood of recession avoidance increased. Expectations for both headline and core personal consumption expenditures inflation to reach 2% by the close of 2025, that's a year and a half from now, people, were widespread. Anticipations aligned with a 25 basis point target range increase during the July FOMC meeting, with most survey participants suggesting that this might conclude the tightening cycle. Though additional tightening was still plausible, real rates were projected to rise into first quarter 2024 and stay above anticipated long-term neutral levels for a few years. Money market trends and policy implementation remain stable, with the on-RRP facility effectively supporting money market rates. And that's probably the reverse repo market where they move money back and forth behind the scenes overnight. Let's see here. Treasury bill issuance exceeding on RRP and on RRP expected rates led to decreased on RRP balances. A sustained reduction in on RRP balances and growth in bank reserves were foreseen by year end. The committee approved domestic transactions unanimously with no foreign currency intervention during this intermeeting phase. All right, next up is the staff review of the economic situation. During the July 25th and 26th meeting, available data indicated a moderate rise in real GDP during the first half of the year, accompanied by a progressively narrowing disparity between labor market supply and demand. Inflation, as measured by the 12-month change in PCE price index, remained elevated through May and maintained its elevated status in June. Non-farm payroll employment's second quarter expansion showed a slower average monthly growth since the recovery began in mid-2020, though it is still robust compared to pre-pandemic levels. The employment rate reached 3.6% in June, while workforce participation and employment to population ratios remained stable. African American and Hispanic unemployment rates increased, remaining above the national average. Average hourly earnings showed a 4.4% increase over 12 months ending in June. Consumer price inflation, although displaying signs of easing, remained elevated. Core PCE inflation reached 3.8% over 12 months ending in May, with the 12-month change in CPI reaching 3% in June. Real GDP growth in the second quarter seemed consistent with the first quarter, but private domestic final purchases hinted at second quarter deceleration. Manufacturing output rose, supported by an increase in motor vehicle production. Foreign economic activity, indicated by the Purchasing Managers Index, PMIs, revealed a second quarter foreign growth slowdown due to various factors, including weaker external demand and the technology sector slump in many Asian economies. Global manufacturing activity remained weak, while foreign headline inflation continued to decrease, influenced by commodity price declines affecting energy and food prices. Many advanced foreign economy central banks increased policy rates to tackle inflation, whereas central banks of emerging markets generally remained unchanged or hinted at potential rate cuts in their forthcoming meetings. All right. Next, after that, is the staff review of the financial situation. During the intermeeting period, economic data suggested continued economic resilience and a slight reduction in inflation pressures. Market participants perceived a somewhat more restrictive policy stance than anticipated, while the implied federal funds rate path increased modestly. Equities rose, corporate bond spreads tightened, and nominal Treasury yields increased at shorter maturities. Foreign central bank banks' policy rate hikes slightly increased short-term interest rates in advanced foreign economies, although some economies saw downside surprises in inflation and PMIs. Most foreign equity indexes rose, and corporate and emerging market sovereign bond spreads narrowed. The trade-weighted broad dollar index declined moderately, reacting to weaker than expected U.S. labor market and inflation data. The U.S. experienced generally stable short-term funding market conditions, but on RRP take-up notably declined. Treasury bill issuance after the suspension of the debt limit attracted robust demand, affecting money market rates. Overall borrowing costs for businesses, households, and municipalities remained elevated, while the banking sector's ability to fund loans remained stable. While credit availability for high credit score borrowers stayed broad, lower credit score households faced tighter mortgage credit. Consumer credit markets remained accommodative, but banks expected to continue tightening lending standards for credit card loans. Overall, credit quality was solid, though concerns were expressed about credit quality deterioration, especially in the commercial real estate sector. The stability assessment of the financial system highlighted notable vulnerabilities associated with asset value pressures and funding risks, with financial institutions experiencing notable outflows of deposits at times. All right. And we got two more sections here. Staff Economic Outlook. The staff's economic outlook for July FOMC meeting indicated an improvement compared to the June projection. Economic indicators had shown stronger performance since the banking sector's stress in March, leading the staff to revise their assessment that the economy might enter a mild recession by year-end. However, the forecast still anticipated that real GDP growth in 24 and 25 would lag behind potential output growth, potentially causing a slight rise in the unemployment rate. The staff's projection suggested a decline in total and core PCE price inflation in the upcoming years. A significant portion of the drop in core inflation was predicted for the latter part of 23, with indicators indicating a slowdown in the growth rate of housing services prices and other core prices. Inflation was predicted to ease further throughout the 2024 as demand and supply imbalances resolved. By 25, total PCE price inflation was estimated to be 2.2% and core inflation expected to be 2.3%. Staff continued to view the risks to their baseline economic projection as leaning towards downside possibilities. In terms of inflation, there were concerns of inflation dynamics proving more persistent than expected or the emergence of supply-side shocks. Moreover, the potential need for additional monetary policy tightening due to higher or more lasting inflation was deemed a downside risk to the economic growth projection. All right. I think this is the last one here. Yep. I think. Oh, no, there's two more. Sorry, spoke too soon. Let's see here. Participants' views on current conditions and the economic outlook. Told you this is a long article to cover. During discussions on current economic conditions, meeting participants acknowledged the moderate expansion of economic activity characterized by robust job gains and a low unemployment rate. However, inflation remained elevated. While the U.S. banking system was deemed sound and resilient, participants noted that tighter credit conditions for households and businesses could potentially impact economic activity, hiring, and inflation, though the extent of these effects remain uncertain. In light of this, the committee remained particularly vigilant regarding inflation risks. Assessing the economic outlook, participants recognized the resilience of real GDP growth during the first half of the year. Despite this momentum, a gradual economic slowdown seemed to be underway, consistent with the cumulative effects of the tightening of the monetary policy and its impacts on financial conditions. Participants debating the timing of these policy effects on the economy and whether their consequences had already materialized. Generally, participants agreed that monetary policy tightening appeared to be functioning as intended, gradually slowing the real GDP growth, which would help reduce demand-supply imbalances. Participants discussed factors affecting consumer spending, noting that despite some resilience due to strong household balance sheets and job gains, tighter financial conditions were anticipated to result in slower consumption growth ahead. The business sector also received attention with improvements in firms' cost structures noted. However, participants indicated that economic activity could be influenced by factors such as leaner inventories and uncertainties in the commercial real estate market. Concerning the labor market, participants observed that while it remained tight, demand and supply were beginning to find a balance. They noted evidence of easing labor demand and increasing labor supply, factors contributing to this equilibrium. Participants emphasized the need for further progress in balancing demand and supply in the labor market and expected additional softening of labor conditions over time. Participants acknowledged several signs that inflation pressures could be waning, including some softening in core goods prices, slower increases in shelter prices, and declines in inflation expectations. However, elevated inflation was still causing concern, particularly its impact on low-income families. Overall, there was a consensus that more data and evidence were needed to confidently affirm that inflation was moving towards the committee's 2% objective. Given the uncertainties stemming from the effects of past monetary policy tightening, participants highlighted risks both to economic activity and inflation. Upside risks to inflation included potential supply chain disruptions and scenarios where aggregate demand failed to slow sufficiently, resulting in persistently high inflation. Downside risks included a sharper economic downturn due to cumulative monetary policy tightening and more substantial effects of tightening bank credit conditions. Regarding policy actions, the majority of participants agreed on raising the target range for the federal funds rate to 5.25% to 5.5%, placing monetary policy further into restrictive territory. This decision aimed to reduce demand-supply imbalances and restore price stability. However, some participants expressed preference for maintaining the current rate, believing it would allow for further evaluation of progress. Overall, participants emphasized that data-dependent nature of future policy decisions and the importance of communicating the committee's commitment to achieving its objectives. All right, and then the committee policy actions. That's the last section here. There we are. During discussions about monetary policy at this meeting, members acknowledged the moderate expansion of economic activity and robust job gains, leading to a low unemployment rate. However, they noted that inflation remained elevated. Members reached a consensus that the U.S. banking system was sound and resilient, while they agreed that tighter credit conditions for households and businesses could potentially impact economic activity, hiring, and inflation, and the extent of these remained uncertain. Members reiterated their vigilance. Okay, we already talked about that. To align with the committee's objectives of maximum employment and 2% inflation over the long run, members collectively decided to raise the federal funds rate to 5.25% to 5.5%. They also committed to ongoing assessment. Yeah, this is pretty much just a summary here in this last section. So, all right. And let's see here. The next, let's see. Was there anything else of any real value here? Yeah, down here. All right. The committee also authorized the rollover of principal payments from the Federal Reserve's Treasury securities holdings that exceeded the monthly cap of $60 billion. Furthermore, they were set to reinvest principal payments from agency debt and agency mortgage-backed securities that exceeded a monthly cap of $35 billion into mortgage-backed securities. All members, except for the chairman, voted in favor of these actions. The Federal Reserve Board of Governors also voted unanimously to raise the interest rate paid on reserve balances to 5.4% and to increase the primary credit rate by 0.25 percentage point to 5.5%. The next committee meeting is going to be on September 19th and 20th, 2023. All right. So I apologize. It was a long thing to cover, but figured might as well go section by section and cover each one. So basically, they raise rates by 0.25%, but this is all the stuff that they look at and talk about and hem and haw about. Well, here's what the economy is doing. Here's how it is, blah, 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 blah. We sound important by putting a lot of words on paper, but in reality, they created this problem. So I don't think they're going to get us out of it without any real major damage. But hey, again, I could be completely off base. All right. Well, that's everything I had for today. Apologize, went about 5 or 10 minutes longer than normal. But like I said, that's all I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. I hope you have a wonderful evening, and I'll talk to you next time. Adios.